Hi, Rocco.
Hey Lynn, how you doing?
Good. How are you?
Okay.
Hi, Vivian and Jay.
Hello. I'm going to be a little invisible because I don't think you want to see me eating my dinner.
Yeah, hello.
Hello, Vivian. How are you?
Speaking.
What's that?
Who is speaking? We didn't see your
Oh,
name. It says info.
oh, this is Lynn.
Okay. How are
Info
you?
Lynn.
Okay.
Good.
All
How
right.
are you?
Okay.
I'm just here to start the meeting and then I'm
Yeah.
gonna hop off
Okay.
when Ian comes.
Because
But
sounds like the voice is familiar.
yeah, I saw you at the meeting.
Okay.
Yeah. Thanks for
Hey,
all your
Lynn,
help.
quick question. Is this going to be recorded? Because I have something else that's booked at the same time here. I don't want to jump back and forth.
Yes, this is recorded and we'll send it out to you in
Okay,
a day or
awesome.
two. Yeah,
Okay, thank you.
sure.
I may actually do the same thing.
Well, don't you want to hear Rocco in person and ask your questions?
I'm not sure I'm that excited about hearing him in person, and I don't have any questions right now. So
Oh, he has a lot of good info to share.
Hey, Rocco, you there?
Yep, I'm here. I'm just trying to get my video on. There we go. Yep, how are you,
There you
Ian?
Gotcha. Okay, cool. All right, let's just give it a couple minutes, let people join the room, and then we'll maybe like 7:03 or so kick it off.
Sounds good.
All right, very good. Can you see me? I can't tell with this thing.
Clearly, yeah. No
Okay,
problem.
cool. Sounds good.
It looks like Rhonda's note taker is on. I don't know if that's Rhonda from the board or a different Rhonda.
Those are usually, those show up in every Zoom meeting. I don't really know what those are. Yeah, I don't know if it's Rhonda or not that you're talking about, but there's always a note taker in the
Yeah.
Yeah.
I think I'm gonna take Rhonda out because we don't allow note takers, but I'll contact her to see if it's the Rhonda I know. And but we record it.
Right.
So we're recording the meeting. So I'll send her a copy of it. Because
Okay.
we don't really allow note takers. Sometimes they can take over. So let's see. There we go. Okay. Okay. All right, looks good. Well, I'm going to make you host, Ian,
Okay.
and then you can do your thing with Rocco. There we
Sounds
go.
good. Thank you.
All right. Have a good meeting, you guys.
All right, you got it.
Bye.
Bye.
Thanks, Lynn.
Sure. Bye.
All right. Let people fill in as they come, but why don't we roll from here, and when they cut the video up, we'll start it right here. How's that sound, Rocco?
Sounds good. Sounds good, Ian.
All right. Okay, so let's start with, I would like to thank everybody that's showing up tonight for the Zoom meeting. It's been pretty good. As we started this about a year ago, and I really like to thank and extend my gratitude to SJREIA, easily the best investment group in South Jersey. And if anybody hasn't been to the main meeting, it would be worth checking out for sure. The in-person is hard to beat. I know Zoom is convenient, certainly is, but in-person meetings is really where you develop relationships. So with that said, we have a guest tonight. I'd like to bring in different areas of real estate investing, different hands, different sections, because it's all not just about buying or selling. There's so many other moving parts. So we're going to invite Rocco Esposito, who many of you already know, to the show of the Esposito Insurance Group. So tonight's topic will be insurance. So Rocco, thanks for coming on.
Thank you. Thanks for having me, Ian.
Yeah, no problem. So I grew up actually in the insurance world because my father ran a brokerage for 30 or 40 years, and then sold it. So I know a lot about insurance, and I can tell you it's really boring, but it is so unbelievably necessary to have in real estate investing that it's like you're kind of crazy to not know what you're doing with insurance, definitely in the real estate investment space. So what do you provide to investors, Rocco, that when they come to you, what's your average person maybe from the group SJREIA that says, hey, I need some insurance? What do they say? What do they come with for you?
Well, there's a couple of different areas that we see a lot of. One is flipping. People who are interested in basically rehabbing a house and then selling it. That requires a particular kind of policy. We like to give a little bit of advice with that also, if they've got contractors that they're working with, and how best to protect themselves with that. And then we have people who are landlords, people who may be buying a 1, 2, 3 family house, and they may want to, get that insured. Some of our customers will like us to look at more than that. We'll look at like auto at home. We'll look at like an umbrella to put on top of everything, which I'm a big proponent of. That's how you protect yourself from like a really big lawsuit that can sort of really like wipe you out financially. So we'll look at things on the overall for some people. But like I said, flipping, landlords, 1 to 4 families, that's a big piece of what we do for the folks in the South Jersey group.
Yeah, now from the lending perspective, we make it mandatory with any of our loans, because I can tell you, I've done quite a few loans in this area, and we have had, I would say probably to the tune somewhere between 1 and 3% of total loans done have an insurance claim, anywhere from like a small fire to full on burn down. And I have had investors that they let their insurance lapse, they made it a secondary priority. And a lot of times you're only talking like you got a $300,000 house, you're talking maybe a couple grand on a flip or 2, 3, 4 grand, whatever, on the policy to cover yourself. It burns down and you're out 300 or 400 grand. Now, fortunately, what we do is and I can talk to you a different time about this, Rocco, but we have a policy in place that will force coverage from the lender's perspective to cover our tail with that. Do you see some pretty crazy claims of people being like, I didn't have insurance, or I thought I had it, or, what kind of weird stuff do you run into like that? I'm sure you get some strange calls.
Well, anybody who's been doing this a long time has probably got a bizarre story or two. I mean, I had a customer who was purchasing what was an old church at one time on a triple net lease. And there were certain criteria in the lease that they met upon which they had to insure the building. They didn't do it. They met those criteria. They actually hit the point where it became truly a triple net. They didn't insure the place. And about a year and a half later, somebody showed up and says, I fell in front of the place during that uninsured period. And they had to get a lawyer and they had to defend themselves. And there was nothing I could do for them. They simply didn't want to spend the money like several weeks early from what they perceived to be where the responsibility occurred to have the coverage. So we've seen that. Another thing that's happened that was very strange. I had a customer once many years ago, built a house from scratch. He actually he paid about $1.4 million for this house in 2009. And the day he moved into it in the middle of March in 2010, the place really did burn to the ground. And it was a very hot fire. The foundation was warped. It was a total loss. And this is a situation where at that time, there was a big boom in China, and building materials were really kind of skyrocketing in cost. So when they went to do the rebuild, it's like the summer, and they came back and said it's going to take about $2.2 million to rebuild this house.
Wow.
And we had insured it. He had like virtually nothing he could share with us from a mortgage. It was a private, a cash purchase. We insured for $1.5 million. And the saving grace for him is he had a higher end policy that had what they call extra extended replacement on it. So the policy would pay up to 2 times the value of the house in the policy at the time of a claim. So the companies did pay that and give him $2.2 million, and he was able to rebuild the house again, back to his specifications. But that was, a very unusual one.
And seriously fortunate. Now, is that a standard thing that you put in your policies, or is that something you have to request?
What, the extra coverage? Well,
Yeah.
it depends on the company. It depends on the type of policy you have. A flip policy will almost never have it if you're buying one for a rehab. If you're buying one as a landlord, many policies do not have that. Some do, and some will range between, say, 20% above the value of the home up to maybe 50%. There are a handful that might guarantee the rebuild of the home no matter what the cost. There's usually a cost associated with that, and very often people want to, buy something that's inexpensive and don't really take into consideration some of the extras that might be helpful for them. But yeah, they're out there. You just have to really look a little bit to try to find it.
Interesting. Now, if you like, what is like the average cost? Like, if somebody's flipping a house, they're buying it for 250, they're putting 150 in, they need to come to you for insurance. Like, what kind of costs are they looking at for a you don't have to give me, hold you to it kind of number, but
It depends on what you're looking to cover for. So, policy that we commonly use will have what they call an agreed value on this, as opposed to insuring to rebuild, which means the person who's buying the policy can dictate what they want to insure for. So in your case, you said 250 to buy, $100,000 in. I assume the ARV might be 425 or 450.
sure.
So they've got a range of what they can really insure for, unless they've got a mortgage or a loan that's requiring a certain amount of coverage. If that's the case, they may, the minimum I tell them to insure for is cover your investment here. You've got $350,000 at minimum that you should really cover this house for. And then I'll point out and say, if you really want to insure it to rebuild in case of a fire, let's look at what the reconstruction cost is, which is what an insurance policy really ought to do. And that could be something on the order of maybe, a 2,000 square foot house might go for $500,000 to rebuild, which isn't quite the same as a build. It means everything's one off. Labor is documented. You've got to get rid of like the old damaged parts of the house as well, and it tends to run more higher. So, given that $350,000 of coverage on the house, that'll probably cost you, I'll give you an exact number, $2,100. You're going to pay about $2,550 for that in total. That would insure the house for $350,000. It would give you $1 million in liability on the premises if somebody were to be injured or hurt in the premises, or somehow you damage somebody else's property next to you.
So $2,500 for an annualized policy for a flip like that. So if somebody's got like a 1 year,
yeah, okay, $350. That's pretty much the same price up and down the state wherever you go.
It's crazy to me when people, avoid that when I have, it's like the last place you want to look to cut a cost is the one that could it's the hard stop, right? It's the stop that's like, of all the risk on the table, it's the one you got to have in place. It always blows my mind. And it doesn't happen often. I mean, most people, they get their policy, they flip out, it's fine, it's done. But when it does occur, and then, we have had scenarios where our forced coverage was the policy that, from our perspective, and the borrower let it lapse.
Right.
The claim had to come through, and the borrower was in a totally different position at that point, which I won't go into in the video, but it's just not the place to cut costs for an investor in general. I don't care if it's landlording, I don't care if it's flipping. You shouldn't do that. Talk about the umbrella policies. Where does that, how does that tie into investors? Multiple houses, or where do investors really step in with that?
Okay, sure. So an umbrella is a policy that sits on top of other policies. So to start with, think of it like this. You've got a home insurance policy where you live. You've got cars that you insure. You have maybe a couple of policies that you rent out to other people. And each of those policies has liability on them, which is really lawsuit protection. An umbrella policy will basically stack on top of the liability in all of those policies and then give you more. Usually you buy in increments of $1 million. So let's suppose the scenario I'm giving you. You got somebody who's maybe married, got 2 cars, 2 drivers, house they live in, and then you've got 2 investment properties. If you look at the overall portfolio of everything that they've got that they're insuring right now, the biggest risk they've got comes from the cars. 80% of any claim that'll be very large and exceed a policy will come from a car policy. So, it matter of scale. If you think about what it would cost right now if you injured somebody by tearing up their knee in a car accident, they will sue you. They will probably win in New Jersey $750,000 from you on settlement of the lawsuit. A typical car policy that's decently configured is going to have $250,000 of coverage in it for any lawsuit brought against you for a bodily injury. So that's a shortfall of $500,000. So the umbrella is providing another $1 million or $2 million or whatever you purchase of additional lawsuit protection on top of that. It stacks up. So if you have a $2 million umbrella, that would give you $2.25 million to both defend you with a lawyer and then to pay out if there was something brought against you if you lost a lawsuit. So that's the most common way that somebody can get into trouble where they've got a large lawsuit and other assets are at risk. Less likely, second on the list would be those landlord properties. We see a lot of slip and falls in a landlord house. We see a number of situations where people have a dog in the premises that might not be known to the landlord, or maybe it is, and the dog will bite somebody. If that happens, I will guarantee you the landlord will be brought into the lawsuit. And if it's a bad enough bite, that can go for a lot of money also. And again, the umbrella will sit on top of that and to provide extra lawsuit protection, extra coverage there. So people will say to me, well, I'll get an LLC. I'll put my landlord units into an LLC. And what they need to keep in mind is that's a one-way pocket, basically, to keep the lawsuit away from you. So if something happens inside the LLC, if you do everything correctly with your money, it will stay inside. It won't come back to you to go back to you as an individual, where then all of your other assets might be in play. Conversely, though, you have a car accident. That LLC is in play because it's an asset that you own, and that asset, you could have negotiated that away as part of a lawsuit settlement. You could end up diverting the funds. Technically, you're supposed to divert the funds from an LLC to another party if you lose a lawsuit until the lawsuit is satisfied. In practice, your lawyer will probably negotiate with the other party's lawyer and work something out. But again, that's where having that umbrella, that $2-3 million or whatever on top of your car policy is really essential to protecting those investments you've got. Even your flips, they're going to be all subject to, having to basically liquidate them to pay off the lawsuit if you got sued for a car accident. Again, it really is an 80-20 rule. 80% of claims that hit an umbrella come from a car accident. 20% come from everything else, which includes landlord policies, homeowners, motorcycles, everything else.
That's interesting. Now, what does it cost to have like $1 million umbrella on top of whatever you got? Like what I don't know what the cost on something like that would be. What would that?
It depends on a lot of things. So if you live in like Pennsylvania or Philadelphia, it may price very differently than New Jersey. Philadelphia tends to be a more expensive state for lawsuits. If you have in New Jersey, say 2 cars, 2 drivers, you've got 2 rental properties, 1 single unit, and a house you live in, you might be looking something on the order of maybe $350 to $400 for $1 million. The second $1 million of coverage might cost you maybe $600 in total, maybe 575 or 600
per year.
And per year, if you've got a lot of assets, you start thinking, do I need to get like a $5 million umbrella? And if you do that, maybe you're looking at $1,400. Now, what can change that? If you have a situation where you got a child who's driving, and you say my 17-year-old just got licensed and I got them a car, that's going to add a lot onto the cost of an umbrella because it's a lot riskier. It's a lot more likely that driver is going to get into a car accident. If you have a lot of rental units, like 4 or 5, 20 units, you'll be paying by the unit. That'll increase the cost. So I'm giving you a basic in Jersey. You go to Pennsylvania, $2 million is going to cost you maybe $800, $900 for a similar kind of portfolio. It tends to price more highly there.
So you're like 80 or $90 a month. I mean, you're not talking exorbitant money here.
That's not where the money is for insurance typically.
Right. Okay. I mean, that seems pretty easy for somebody to, you should probably, if you're 40 years old, you have kids, you have a car, you should probably have this, right? You should probably have an umbrella policy, right? Like it's in that space.
Well, even if you're starting out, so let's suppose you're like 27 and you're doing your first flip and you have maybe a condo you own or an apartment, you still have exposure because if you lose a lawsuit and hurt somebody badly enough, the lawyer for the plaintiff can come after you and basically say, we want to garnish your wages. So if you've got a pretty good job and you're doing this on the side, you basically stand to lose like income for many, many years to pay off the lawsuit. And again, the umbrella will help to keep that under control and inside a policy, not out of your pocket.
That's interesting. Yeah, that's something I never really thought about. I have different ways of protection myself, but the umbrella policy is something that I definitely know that is worth looking at because it's really pretty cost effective for the average person. It's really not a deal breaker in any stretch. It's not like do you lend nationwide, or do you lend specifically in New Jersey and
To
Pennsylvania?
us, I mean, we're in 22 states.
Oh,
Primarily, it's New York.
Florida? Are you in Florida?
Badly, but yeah, we're in Florida. And the reason I say that
Yeah.
there's been a crisis in Florida with just insurance in general.
Yeah, I was going to ask you about that. I mean, we run into that. What are you doing? How does that work? I mean, I know this isn't really pertaining to New Jersey, but I'm curious because Florida specifically, yeah.
I think it's a really good point to bring up, because a lot of the dynamics that we see in the Florida market have begun to really affect here in New Jersey as well.
Okay.
So let me kind of take a step back, and then I'll kind of touch on Florida and tie this in. There's a concept in the industry called reinsurance. So reinsurance is a policy an insurance company buys to protect themselves from like a really catastrophic loss. So if you're an insurer in Florida, let's pick on one, St. John's. They went out of business after Hurricane Ian hit in 2022. They can turn around before they went bankrupt and say, we want to buy a policy with another company. If we have a single storm or event that causes more than, say, $3 million in losses, then we get to file a claim with somebody else and offload this to somebody. So they're buying a policy for themselves. So what we've seen with reinsurance costs is they skyrocketed nationally. New Jersey, they're up 190% over the last 3 years. And reinsurance costs for the typical insurance company are about 25% of their overall costs. So if you're, a smaller company, Philadelphia Contribution Ship's a company we sell a lot of policies for, and they're, basically looking to buy a policy, they're now paying about 200% more for 25% of their overall costs than they were in 2022. Reasons for this are pretty much what you might expect: fires in California, fires in Colorado, severe wind events out in the West. Hurricane hits Asheville, which shows that once again that a really major hurricane can cause an enormous amount of damage deep inside the country, not at the coast. And then in general, just storms up and down the coast that might be smaller, it might not be named storm, but just tend to cause a lot of havoc. We're seeing in New Jersey, for example, more tornadoes than we used to. Statistically, there are just more of them because of the weather changes. So reinsurers look at this stuff and they make evaluations on, can we be profitable? And that's why the cost goes up. So we've seen both increases in costs for reinsurers, and we've seen people withdraw from the market. So it's supply and demand, just like regular economics. You've got less companies providing reinsurance, the cost automatically becomes higher. They can charge more because there's less available for other companies to buy. So that became a big issue in Florida. It started there. And it started 10 years ago, 12 years ago. And gradually these problems have become more prevalent in places like New Jersey and even like parts of Pennsylvania, which are closer to the coastline. If you look up the Delaware up through Philadelphia, they tend to be very similar to New Jersey with reinsurance and coastal attributes as well. New York's not a different story. New York's got a lot of problems because not only there's some coastal exposure with lots of houses in places like Long Island and the 5 boroughs, but you also have a very favorable lawsuit environment for plaintiffs there. And that tends to drive up insurance costs also if companies lose repeatedly in court, because courts are very predisposed to, taking care of the plaintiff and not the defendant. That will tend to drive your costs up as well. So Florida right now, to kind of get more specific, you have a problem where most of the major carriers have pulled out of the state. What's left right now are small undercapitalized companies. When Hurricane Ian hit in 2022, I mentioned St. John's, 7 companies went bankrupt within 6 months after that hurricane hit. And if you were unlucky to be with St. John's, you were really unlucky because they're not an admitted carrier. They had no backing from the state's guarantee fund, which means if they went out of business, anybody with a claim open with them lost everything. You got nothing. Wow. You fell in line with creditors. So, that type of an environment has kind of come up the coast here to Jersey. We're seeing a lot of the major carriers have put restrictions on what they'll insure because their costs are up, and the state here does not let companies really increase costs particularly quickly. It takes a long time to get that through, and usually in repeated shots. Travelers, as an example, right now is writing in 4 counties in the state: Morris, Sussex, Warren, and Hunterdon. Other counties are not open for business with them. And those that they do write in those 4 counties have to be within 40 years old as the house, 15 years old on the roof. So it basically has brought down their flow of homes they're insuring in New Jersey to a trickle. And what's left in places like, Gloucester County and out towards the shoreline, you have smaller carriers there. Not as badly capitalizes what we see in Florida. These are like regional companies that cover 4 or 5 states and usually have a lot more financial standing, but nonetheless, they're still smaller. They don't have the ability to withstand a super large event as well as maybe one of the massive carriers might.
Well, okay. So what we're running into in Florida is simply the fact that, like, so when people approach us, we go, yeah, sure, we'll do the, deal looks great or whatever. And then we go, do you have insurance? And they go, no, they just,
Right.
they don't. And then it's like, because we're finding out, like, the cost to insure people that take a flyer out, or companies taking a flyer out, it's like tens of thousands of dollars in some of these scenarios, like for up to 1 year. It's crazy. And so people are like, I'm going to run the risk. And then we go, we can't lend to you if you don't have insurance. So I was just, wondering what you see. Do you have any way around that, or are you just not really doing anything in Florida right now?
No, well, most out-of-state agents have been kind of severely decreased from writing in Florida because of the company capacity issues. Like, remember, Florida, think of Travelers. They're only doing it in 4 counties in New Jersey. They're like out of Florida at this point. And what they might say is anything that we will allow to be written here, the very small amounts of stuff that might be in the square middle of the state, only Florida agents can write that right now. And so it restricts greatly the amount of opportunity somebody got, somebody like you to actually find the policy, because you've got to really dig hard to find it. Most of the majors in Florida, I'm even talking about like the captive ones where you've got like one agent for one company, like Allstate, have ceased everything. They simply don't insure anywhere in the state anymore for property.
So people are just out of luck?
You're out of luck, or you're going to the state. There's it's called Citizens. It kind of looks like a company, but it's really the state selling policies themselves. In New Jersey, the same kind of a concept is called the New Jersey Fair Plan. It's basically meant to be the insurer of last resort. In Florida, the last resort insurer writes about 33% of all new business right now.
Wow.
Which is extraordinarily a big percentage.
Wow. And can a broker sell that policy from that the state is then the insurer for, or no? Or does it have to come? Are there guidelines or different ways to go about that? And
I don't personally, I don't push it. The reason why I don't is because it became a very complicated state. And my personal philosophy is, if I have to really bend things and try very, very hard to find a policy, I'm probably got a better chance of making a mistake for somebody. Where I found something that works and maybe there's a gotcha in there that I didn't know about. I'll give you an example. There's a company called Olympus in Florida that is still active. They're a small company. They insure condominiums, they insure houses, and they actually go pretty close to the coastline. If you open the policy up under the covers, there are some strange things to put in the policy that limit your coverage that, I as an out-of-state agent might not know about. Like, for example, I had a customer had a very, very expensive house in Naples. He took a policy from Olympus from a local agent, and I said, well, send it to me. I want to take a look at it. And inside the policy is a $10,000 maximum they will pay out for a lawsuit that emanates from a slide that's attached to a pool. And he had a slide in his pool. So they threw this gotcha in there, which basically severely limited his coverage. So if he had children over and a kid fell off the slide and got hurt, he was virtually uncovered in the lawsuit. And that's common in Florida. They allow those kinds of restrictions more readily than other states do. And that's a reason why I'm like very reluctant to dig too hard to help somebody who's in Florida. I'll say you probably should find a local agent just because of that. New Jersey's quality of policy doesn't have those same afflictions. The department here is much more rigid about protecting the client, and they'll make sure that you've got like full dog coverage. If you have a dog that bites somebody, you have coverage for pools. There's no limitation that a company can put onto that. Now, can I talk about something a little bit more esoteric just for a second?
Yeah, go for it. Go for it. Let's do it.
Okay. Think of it like this. There are 2 kinds of insurance companies in aggregate. You've got those that are admitted in the state and those that are not. An admitted company means that they have agreed to go through the Department of Banking and Insurance, follow the rules set forth by the Department of Banking and Insurance in terms of policy quality, and then in return, they get to be first line. Their policies can be sold by local agents in the state relatively easily. And they also have a guarantee fund that backs them up. That means the state's basically providing insurance on the insurance company in case of insolvency. You can't always get that. If you're buying houses to do flips, sometimes you'll get what they call a non-admitted policy. A company did not have to go through the Department of Banking and Insurance. And those policies can have like anything in them. You can have like limitations where they knock out coverage for lawsuits emanating from the pool on your premises, or a dog that bites somebody on your premises. They might say that the existing house that you're building on in a flip might be valued at what they call actual cash value, which is not good for a client or for somebody lending. And these are things that you don't typically see on admitted policies. So you get all these gotchas on the policy. And then if there's an event that knocks them out of business, there's no backup, there's no guarantee fund. So the reason these companies exist is they handle what they perceive to be very difficult things to insure. Coastal properties, houses in Florida, people who've had like 2 or 3 claims. Maybe somebody's got a dog that's bitten before. That's almost impossible to insure. And these companies will say, we'll insure, we're just not going to cover the dog. It's completely excluded. And that's an example of not admitted. And that's something that we really try hard not to give to people because it's very, it can be damaging to them. There are cases where it has to be done. If you're on a barrier island buying a shore home, sometimes it may be all you can get. If you're doing Airbnb in that situation, you almost certainly can't get it what they call an admitted policy. You've got to go to a non-admitted company like a Lloyd's of London is one that might give you a policy. So they're used for difficult situations. They carry more risk inherently, and it's easy to simply say, "Oh, I bought a policy, I'm good," and not really understanding that there's some severe limitations. One such limitation I mentioned for an investor is something called actual cash value coverage. That's not a good thing. You have a couple of different ways. There's 3 ways you can really have a home loss, a settlement for a piece of property on a policy. Replacement cost is typical. That's what you want to see. It means if there's damage, the company's got to put it back. Even though it's all going to be new materials and your stuff is older, they've got to give you back all new stuff. That's desirable. Under some circumstances, you can get a policy that I described before for flips. It's called an agreed value policy. You buy the policy and then you pick a stated amount. The company simply says, we'll pay up to that amount. No problem, no penalty. We're not going to clip you. The actual cash value policy is not so good. That means that they'll basically say to you, well, you can insure for what you want for, but we're going to take a co-insurance penalty on a loss. So if it would take $400,000 to rebuild a 2-family that you're buying, and you insure it for $300,000, well, you've got a 25% shortfall from where you should be. So we're going to clip you 25% like right off the bat. And then we're going to look at depreciation. And we're going to look and see how old everything is that's been damaged, whether it's wire, wood, paint. And we'll make a determination as to what the useful economic life left is. And then we're going to make a deduction for all the time that this basically has been out there in the field, and we're going to reduce the payout more to you. And so at the end of the day, a really old house that you underinsure, you may get, 20 cents on the dollar for the claim. And the only time that kind of a policy really pays out well is if you have a total loss and it just exceed go through all the coverage and they simply say, here's a check, take the whole thing. But that's not common. Usually it's something less, and usually you get hurt really badly on a claim. So a lot of flip policies will have this actual cash value piece for the existing structure. And they'll say, well, anything new you put on, well, we'll give you a replacement cost, which is kind of silly because it's brand new anyway. So there's like 0 depreciation to take on it. So, basically that's an example of where you might buy a non-admitted policy where it's a major gotcha on the property side, not protecting you for a lawsuit.
I think that's, I'm just trying to run through like the cases that we've dealt with in our head, and I'm like, did they run into that? Did they run into that? And I can't think of anything off the top of my head that was like a got you. But these are things that I have to be aware of from a lender's perspective on my side, and my clients should be aware of them. Yeah, I think it's important to know for sure. Yeah.
They have a purpose. I mean, let's suppose you were buying like a really not great condition row house in like Camden or a distressed area. You might say, look, I bought this for $50,000. If I have to insure it to rebuild it, I'm gonna have to pay like $400,000 or insure it for $400,000 to rebuild, even though I bought it so cheaply. And my payback is like 17 months. I'll have all my money back and then start to just make complete profit on it. That's the kind of policy where people might gamble a little bit and say, I'll take the actual cash value type of coverage here, right, and hope I don't get destroyed on it, because their metrics are so good for the payback. They'll simply say it makes more sense. But under typical circumstances, you're building like a small portfolio of townhomes or something like that, doesn't really make sense to clip yourself with that kind of coverage. It's not worth the savings you're going to get by saying, I pay a little less for my insurance. It's just not there. And I advocate you really want to have replacement coverage for it.
Okay, that's good to know. Well, Rocco, I appreciate this. There's a lot of stuff I've learned tonight for sure. And as I said, I'll probably be touching base with you after the show or tomorrow morning. But is there any questions that anybody here in the chat has that is wondering? If you have it, post it in the chat. If you don't know how to do that, if you hit more in the bottom and hit chat, it should bring it up. If not, Rocco, how do people get in touch with you? Like how do you want to reach out to Rocco?
I'll find a chat here and I'll put my phone number into it, I guess.
Okay. For the video's sake, because this will go out to a couple 100,000 people on our list as well. So
yeah, sure.
Audio wise, go ahead.
Okay, 973-284-1083 is our phone number. We're also at espositoinsurance.com. If you want to check our website out, that's got all methods of contact. The phone number I gave you can text as well as call us, by the way.
Perfect.
And
that's at espositoinsurance.com.
Espositoinsurance.com. That's correct.
Perfect. Okay. I'll put that in the chat as well. All right. Awesome. Rocco, I appreciate you coming on tonight, and we will, there's your phone number. The phone number is also in the chat for anybody looking. We will send this out, and thank you very much.
All right. Thanks, Ian. Thank you, everybody, for attending. Take care.